Good afternoon, everyone. I hope you have been enjoying the Convention 8 conference so far. My name is Petr Vaclav, and I lead data analytics, data science, and artificial intelligence initiatives for RGA business units, clients, ventures, and acquisitions across the EMEA region. At RGA, one of my focus areas is digital distribution and digital underwriting. Digital distribution and underwriting provide life insurers with new ways to understand customer behavior, and although difficult to harness, digital behavior and contextual signals provide a lot of insights to improve the life insurance value chain. Today, I would like to share how our RGA and its clients responsibly leverage these signals to drive high-intent traffic, improve customer experience, streamline underwriting, increase conversions, and reduce risks. Over the next 25 minutes or so, I will explain what customer tracking and analytics is and what it's trying to achieve, explain what behavioral and contextual signals are and provide some examples, outline the key challenges of customer tracking and analytics, and I will also share several case studies from across the life insurance value chain, highlighting how RGA and its clients responsibly leverage these behavioral and contextual signals to drive value. And finally, I will summarize my experiences and recommendations and open the floor for discussion. And before we deep dive into the content, let me first tell you something about me, how I got into data science, and what I do at RGA. First things first, I love everything that's got to do with data, numbers, statistics, and trends. My passion for data and numbers has put me on a rather unique academic and career path. I started my career in data science before the term data science was even coined. Back then, it was called data mining, then it became data analytics, then advanced data analytics, then data science, and now it's often called machine learning or artificial intelligence. Despite the ever-changing name, I still feel I have been doing the same all those years, helping organizations to harness the power of their data and solve business challenges across the value chain. Over my career, I had the opportunity and privilege to establish, grow, and lead world-class data teams, which pioneered the use of data science in insurance and financial services. Working in data science has allowed me to work across 5 different continents, where I have helped companies of all shapes and sizes, from FTSE 100 companies to insurtechs and fintechs. I joined RGA in 2020 to lead and support all data science initiatives for internal and external clients in the EMEA region. My focus areas are on digital distribution and underwriting, predictive underwriting, bank insurance, and health and wellness. Finally, I also regularly present at conferences, give lectures, and peer review academic research papers about data science and artificial intelligence. So by now, you might have heard me mention digital distribution, digital underwriting, customer tracking analytics, and several other terms. Let's spend a few moments to define the key terms that I will be using throughout the presentation. Firstly, digital distribution is the process of marketing and selling life insurance through digital channels. This can be either an end-to-end digital process without human involvement, or a hybrid one with human intervention, usually to complete the underwriting and the sales. Digital underwriting, there are many different definitions out there, but I will refer to digital underwriting as the end-to-end digital process to provide an instant underwriting decision for the customer. By customer tracking, I will refer to a set of tools, techniques, and approaches to collect digital customer data, such as behavioral and contextual signals, which can be then analyzed to better understand customer behavior and experience. Behavioral signal is a type of signal or characteristic that describes customer behavior. A simple example would be the time taken for a customer to complete an underwriting journey. And finally, contextual signal is a type of signal or characteristic that provides additional context about customer behavior. A simple example would be the device that was used by the customer to arrive at the website, and that device might be a desktop, mobile phone, or a tablet. Let's now look at what behavioral and contextual signals can be collected in digital distribution and underwriting, and how these signals considerably expand what I call the life insurance signals universe. First of all, traffic source. That really deals with how did the customer get to the website, including the search term they might have used on Google or similar platforms, the referrer, the medium, or even the advertising campaign that they saw and that helped them to land on the site. This information is key for evaluating customer marketing and acquisition activities. Location and time. Where from and when did the customer get to the website, including information like city, region, country, date, and time. Device. What device did the customer use, such as desktop, mobile phone, or tablet, as well as screen resolution, operating system, browser, or the language setting. Traffic source, device, and location and time are examples of useful contextual signals, which also allow us to create dozens of personas and then explore and compare their behavior during the underwriting journey. Clicks, views, and forms are basically the ways how a customer can interact with the website. We do not only record final clicks, views, and submission, but we also look at the previous clicks, edits, and any additional activities that the customer might have done during the journey in order for us to have a complete representation of customer engagement and behavior during the session. Elapsed time will refer to how long customer interacted with the website and its individual components, such as pages, sections, underwriting questions, or even videos. Clicks, views, forms, and elapsed times are useful behavioral signals which, when combined with those contextual signals, allow us to explore and compare behaviors of dozens of personas and really understand customer behavior across the end-to-end journey. There are also other signals that are possible to collect through third-party tracking tools, which capture things like keystroke cadence, typing speed, mouse speed, copies and paste, and many others. However, there are varying views on how valuable these signals might be for understanding behavior, and I will talk about this later in the presentation. So right now, you might be wondering how these behavioral and contextual signals are collected. Usually, you will need to use a third-party tool, a custom tracking tool like Google Analytics or Mixpanel. And although these tools are being marketed as straightforward to implement, there are several challenges you will have to overcome to fully harness the potential of customer tracking. Firstly, simply installing a customer tracking tool like Google Analytics or Mixpanel is not enough. There are many reasons for this, but the main ones are the ones that the tool will not automatically capture all the events that you would like to be tracked. They will also not differentiate between customer traffic, a real customer traffic, and, for example, internal or developer traffic. Not being able to distinguish between those two can fairly skew your results. And finally, those tools will not provide ways to connect customer tracking data with other data sources. And this brings me to the second main challenge, and that's the fact that behavioral and contextual signals from customer tracking are often siloed from downstream data sources like underwriting, outcomes, lapses, and claims. And this considerably reduces the number of analyses and insights that you can get. Therefore, ensuring proper data connectivity is crucial to unlocking value of customer tracking. Thirdly, an end-to-end tracking strategy and plan is required to successfully implement customer tracking and ensure that data connectivity that I've just mentioned. This is usually a technical living document that specifies everything related to customer tracking, not only what's going to be tracked, but also the approaches to data anonymization, processing, and storage. It should also outline approaches to updating customer tracking every single time there is a change to the website. This is super important because any changes to a website can completely break customer tracking. And my recommendation here is to incorporate customer tracking into website development activities and include it in the definition of done in order to ensure that any website release is actually not going to break the customer tracking, but also we will know that the data collected will be sensible and will be useful for us. Fourthly, customer tracking analytics requires a wide range of skills and capabilities. And these might range from web development, data engineering and analytics, data science, behavioral science, search engine optimization, and many others. It's a truly multidisciplinary activity. Customer tracking analytics also require input and oversight from legal and data security and protection teams. Lastly, customer tracking analytics are subject to ever-evolving data privacy laws and AI regulation. If not implemented correctly or maybe used incorrectly, it could lead to collecting personal information, storing personal information across different regions, or even promote bias and discrimination. These are serious considerations, which I will be exploring a bit further in the presentation. At RGA, we have developed capabilities and solutions that help us and our clients to responsibly implement and leverage customer tracking and analytics. This has not only allowed us and our clients to better understand customer behavior across digital distribution and underwriting, but also explore how behaviors in digital journeys and underwriting journeys affect downstream steps in the insurance value chain, such as in-force management and claims. We have leveraged these insights together with behavioral science in order to improve customer messaging, experience, UI and UX, and reduce friction in digital customer journeys. And this finally has allowed us and our clients to drive high intent traffic to the website, improve experience, streamline underwriting, increase conversions, and finally reduce risks. Having explained the objectives of customer tracking and also its challenges, let me now share several case studies from across the life insurance value chain and highlight how RGA and its clients responsibly leverage behavioral and contextual signals to drive business value. At RGA, we believe there is a huge opportunity for life insurers to grow the market and drive organic traffic through online content and search engine optimization, or SEO. SEO is an approach to increase the chances that customers will come across your online content when they are searching on platforms such as Google, Bing, and others. To give you an example, in the UK, every 4 seconds, someone searches for life insurance or a life insurance related keyword on Google. There are thousands of different questions that are being asked, and the numbers are growing. And we are also starting to see similar trends in other countries and regions. However, very few traditional carriers and even new distributors are actively leveraging content and SEO. Instead, they are relying on traditional acquisition channels or online paid advertising. And from our experience, paid advertising on Google, Facebook, and other platforms is becoming very expensive and maybe even too expensive to be a financially viable method of acquiring customers. We supported RGAX's digital D2C initiative called Money for Them, with identifying specific content and SEO keyword opportunities which were not contested by other life insurance and therefore could be used to drive organic, high-intent traffic to the website. We also helped this initiative to optimize the written content on the website and also ensure the website is technically optimized and scores well on Google's page rank algorithm and other algorithms. As a result, we managed to attract organic, high-intent traffic that produced much better results compared to paid advertising. And despite Money for Them being an unknown brand in the market, it's actually the top results for several keywords on Google, such as life insurance without phone calls. In digital D2C journeys, most customers abandon the website before any meaningful engagement. Let's take the example of Google display advertising. These are cheap ads aimed at raising brand awareness and generate large and often low intent traffic. In one RGX initiative, only 3% of customers coming through Google display would click on the Get Your Quote button to begin the journey. We then ran several experiments to increase this call to action conversion rate. Firstly, we learned that more than 75% of those customers who came to the website were coming from mobile phones, and often with smaller screen resolutions. Therefore, we made sure that the Get Your Quote button is positioned on the screen in such a way that's always visible on the landing page. Secondly, we ran several A/B experiments which offered customers a buy incentive in the form of a £100 voucher. And finally, we also learned from the data that we were collecting that women with specific behavioral and contextual signals had a much higher likelihood to get further down into the journey. And we used this information to adjust targeting of Google display ads. As a consequence, we were able to triple the call to action conversion rate. On the graph, you can see it went from around 3% to 9%. And this has not only improved the downstream funnel performance because we were able to get a lot more people down into the journey, but it also increased the pool of engaged customers that we could then remarket to. When you examine different digital D2C journeys, you will realize, unfortunately, that most of those journeys are basic digital copies of advisor-led journeys. However, the absence of human assistance in digital D2C journeys has a significant impact on customer experience, especially regarding the number of decisions a customer must make. Let's take an example of offering a customer different payout options, such as lump sum or monthly income. In our experience, around 80% of customers will explore these different options, but then the majority will still choose lump sum, usually because that option is easier to understand. However, this process of trying to make the choice might take maybe 1 or 2 minutes, which is by far the most time-consuming step in the customer journey. And the longer a step takes, the higher the chances that a customer will drop off and abandon the journey. Similarly, our experience is that 55 to 75% of customers will drop off when having to choose a cover level. Even if you present them with different options like £100,000, £200,000, £300,000, it will not help customers usually much because customers might not know exactly what might be needed for their particular needs and their families. When we run some customer focus groups, we come across customers who might not even know what a cover amount means to them. And from my perspective, life insurers should really adopt much more customer-centric approach to designing digital D2C journeys, not only to improve the customer experience, but also to mitigate the absence of human help. This means combining appropriate UI UX with behavioral science principles to simplify the language, reduce what we refer to as cognitive load and fatigue, and instill certainty, confidence, and positivity to allow customers to make the right and informed decisions. I would also recommend life insurers to experiment with different tools, visuals, or even videos to explain key concepts and help customers make the best decision for them. Getting declined during an underwriting journey is bad customer experience, especially in digital D2C journeys, as there is no human advisor to soften the messaging, put an alternative spin to the messaging, or offer alternative products and ways how to get cover. Therefore, as underwriters, we always try to maximize the straight-through processing and straight-through acceptance rates. However, when optimizing STP and STA rates, we often forget about the downstream effects on sales conversions. It's entirely possible to improve STP and STA rates with little or no impact on sales volumes. At RGA, we have built machine learning models to predict sales conversion rates given different underwriting loadings, while controlling for other rating factors and behavioral and contextual signals. And when you look at the graph on the slide, you will see that conversion rates are high for customers with no loading. There's no surprise. However, conversion rates start dropping significantly when you start loading customers and then fall off the cliff at 200 plus loadings. Such insights enabled us and our clients to explore different strategies to optimize trade-offs between risk, price, and sales conversions, and more importantly, ensure that underwriting changes that are put in place will really move the needle from both risk and sales perspectives. I talked earlier in the presentation about the need for data connectivity, and here is a great example of how connecting digital distribution signals with downstream data can unlock value. We worked with one of our clients to explore the relationships between digital behavior and contextual signals and early lapses. Firstly, we found that customers coming from paid advertising on social media had 2 times higher early lapse rates compared to customers coming from high intent channels such as organic and paid search. From behavioral science perspective, We believe there is a need for better messaging of life insurance and its benefits, especially for customers coming from those low-intent channels like social media. Secondly, we found there is an interplay between customer income, perceived affordability, and lapse rates. As customers' income decreases, the risk of early lapse increases. And when you look at it from the behavioral science perspective, we believe life insurance is seen as all pain, no gain, and even more so for lower income customers, which makes it easier for them to quit. Finally, we also found now that special offers like free premium for first few months can be effective retention mechanism because they reframe the pain of paying for life insurance. And as you can see, at RGA, we are combining customer tracking and analytics with behavioral science to design effective communications and tools to improve conversions and reduce lapses. And the final case study for today, when life insurance professionals hear about customer behavior tracking, the first use case that usually comes into mind is often about detecting suspicious behavior, non-disclosures, and fraud, and how these signals from digital distribution and digital underwriting could be used potentially to adjust underwriting decisions. Signals like time taken to answer an underwriting question or the number of edits to an underwriting question might be good proxies for non-disclosure. Similarly, we sometimes see customers getting rejected only to come back a few days later, change few disclosures, and get accepted, and end up actually buying the policy. Nevertheless, underlying human behavior is much more complex, and it cannot be fully captured by signals collected in digital distribution and underwriting. Therefore, it's very difficult, if not possible, to generalize behavior, especially when it comes to suspicious and fraudulent behavior. For example, progressing slowly through the journey, making edits, or even pasting answers does not necessarily constitute suspicious behavior. Different people will have varying levels of reading comprehension, cognitive abilities, and technology skills. Therefore, significant caution should be given to bias, fairness, and discrimination when building and implementing solutions aimed to identifying suspicious behavior, non-disclosures, and fraud. Moreover, there's also a need for ongoing monitoring and human intervention because we are not at the point where we could generalize behavior and be able to say that a particular customer is fraudulent or not. And this really brings me to the end of today's presentation. The key messages and recommendations that I would like you to take away and hopefully consider when you will be thinking about customer tracking analytics are that, first of all, behavioral and contextual signals from digital distribution and underwriting present both opportunities and challenges for life insurers. These signals can be difficult to collect and harness, but are very valuable for understanding customer behavior. Therefore, these signals are useful for tackling business challenges across the life insurance value chain. And you could see from those case studies that they can target everything from sales and marketing, pricing and underwriting, claims, and in-force management. However, if these signals are not used correctly, then there is a significant risk of bias, unfairness, or discrimination at play. My overarching recommendation would be to focus less on artificial intelligence and focus more on what I term augmented intelligence. In other words, focus on leveraging data and insights to address customer needs and improve customer experience, rather than building tools for automated decision-making regarding underwriting, pricing, and suspicious behavior, for example. And finally, my recommendation would be to ensure that humans are involved, engaged, and accountable for decision-making across the life insurance value chain. Thank you.